Hello, students. Welcome to part 4 of Sources of Business Finance. In the last session, we had learned about what is deposits or public deposit, what is trade credit, lease financing. Now, let's understand what is commercial paper. It is an unsecured promissory note issued to public with a fixed maturity period, which is ranging from 90 days to 1 year. So, issuing commercial paper in India as a money market instrument took place in 1989 to 90. Here, there is an example of promissory note. You can see the example. So, since commercial paper is unsecured, it is issued by highly reputed corporate entities. Commercial banks, companies, and mutual funds contribute towards this kind of instrument. It is also regulated by RBI. Now, when we talk about the advantages of commercial paper, there is no restrictive conditions. So, since it is unsecured, it has no restrictive condition and it has high liquidity, which means they are freely transferable from one to another. And it is also economical because the cost of raising fund through CP or commercial paper is cheaper than the bank loan, and the repayment of CP can be made by issuing new commercial paper. So it is a continuous source of business finance. The another advantage is that companies can keep their excess fund in commercial papers to earn more returns. So these are the advantages of commercial paper. Of course, it comes with certain limitations too. The first one is only sound firm, which is financially strong, which has good credit worthiness. It is suitable for them and only they can issue commercial paper. So limited fund can be raised through this, and extension of maturity period is not possible in case of difficulties. Now, company can also generate fund, or business finance is also possible through issue of shares. So the capital of a company is divided into large number of equal parts or units, and each unit is called a share. In other words, share is the share in the share capital of the company. The aggregate value of share is also known as share capital. Now, those who subscribe to share capital becomes the member of the company and are called shareholders, and they are getting the status of owners in the company. We can see in the picture that how every person who has invested or who have given its share of capital becomes the or gets the status of owner in the company. Hence, shares are also described as ownership securities. Now, we need to understand that what are types of shares? There are two types of shares: equity shares and preference shares. Equity shares are those shares which do not carry any special or preferential right in the payment of dividend or repayment of capital. Equity shareholders are the risk bearers as well as the real owners, as they are entitled to receive any money only after the payment of all other debts. So, when the company is winding up, or in any case, when they are distributing its profit, first the company will have to give and the profits to like its preference holders, preference shareholders, or debenture holders, and then at last they pay to equity share. So, equity shareholders, they are entitled to receive only after the repayment of all the other debts, and the amount raised by the issue of equity share is known as equity share capital. Now, there are certain advantages. It is suitable for risk takers who wants to take risk into business because there is no obligation for dividend. And it is, of course, a permanent source of capital because you pay to equity shareholders only when you earn profit or during the time of winding up, and they get huge amount in lump sum. So there is no obligation for dividend. It provides credit worthiness to the company and there are no charge against the assets. But Equity shareholders, they do have voting rights. That is, company follow democratic management. Now, when we talk about the limitations of equity shares, income is not steady. That means fluctuation in dividend base is based on the profit. Like, let's say, for example, if the company is earning more profit, then the dividend would be given at the higher. It involves higher cost because cost of raising equity capital is very high, and dilution in the control because existing shareholders, they may be taken over by the new shareholders, like when the company makes fresh issues of its shares. And there is complex legal formality for the issue of equity shares. Now, when we talk about the second type, that is preference share, it is the one in which carries certain preferential rights with regard to payment of dividend at a fixed rate during the continuance of the company. So over here, the company is supposed to pay the dividend to preference shareholders out of its profit. The capital raised by issue of preference share is called preference share capital, and there are certain privileges which every shareholders get. That is, first is right to get the dividend first at fixed rate before it is given to equity shareholder. As I said few seconds back, that whenever the dividend is distributed, first it is given to preference shareholders. There is also right to get the repayment of capital on winding up before it is paid to equity shareholders. So we can say that rate of return is guaranteed in case of preference share, which is one of the major merit or advantage. And preference in the repayment of capital on winding up is also given. But preference shareholders, they do not have voting rights. So we can say that there is no dilution in control. Equity shareholders enjoy more return in good times, and there is no charge over the asset. This is very economical because cost of raising preference share capital is cheaper than the equity share capital. But again, this comes with the demerits too. It is not suitable for high risk takers, which means that people who does not want to take risk will go in for preference shares. Over here, the return on investment is very fixed and limited. The claim on the asset in the company should be shared with preference shareholders also. And normally, higher rate of dividend, which means that preference share capital bears high rate of dividend than the interest rate of debentures. The another advantage is that it may not attract many investors. So the return on investment is not assured, but it is paid only if there is profit. Dividend on preference shares is not a charge against profit, so no tax benefits are given. Now, we know that there are two types of shares, equity share and preference share. Under preference shares, again, there are various types of preference shares. These are the types of preference shares: cumulative, non cumulative, participating, non participating, convertible, and non convertible. Now, when we say cumulative, they have the right to enjoy unpaid dividend in the year of loss or inadequate profit in the future years. Like, let's say, for example, if being a cumulative preference shareholder, I did not I did not earn dividend last year, then that dividend would be carried forward to the coming next year. So we are enjoying the right of unpaid dividend. Whereas in case of non-cumulative, unpaid dividend is not carried forward to the subsequent year. So in the year where dividend is not paid, then it is lost forever. Next type of preference share is participating. Usual dividend at fixed rate and share in surplus profit of the company is participating. And non-participating means no right to share surplus profit, which is extra profit, or only fixed dividend would be given in case of non-participating. Whereas in case of participating preference shares, whenever the company is earning surplus or extra profit, then the preference shareholder would have the right to get share in that profit apart from the fixed dividend. The another one or the another type of preference share is convertible. These shares can be converted into equity share after a particular period. And when we talk about non-convertible, it means your preference share cannot be converted into equity share. Now, as per Indians Company Act 2013, all preference shares issued by Indian companies must be redeemed within 20 years. So these are the types of preference shares. Thank you.